the rising star of the crypto world. Jeff Yang, the man behind Hyperliquid, the decentralized crypto exchange. Jeff Yang didn't follow the typical path to building one of crypto's most ambitious projects. While most cryptocurrency founders come from finance backgrounds or Ethereum development circles, Yang emerged from the world of high-frequency trading and algorithmic systems at Hudson River Trading, one of Wall Street's most secretive and sophisticated quantitative trading firms. This background would prove essential to understanding why Hyperliquid works the way it does and why it represents something fundamentally different in the decentralized finance landscape. The story begins not with a white paper or a token launch, but with years spent building trading infrastructure at the highest levels of traditional finance. Hudson River Trading is not your average trading firm. Founded in 2003, the company operates with an intensity and technical rigor that few organizations can match. They hire some of the world's best mathematicians, computer scientists, and engineers. These people don't just trade, they build systems that can process millions of data points per second, execute trades in microseconds, and manage risk across dozens of markets simultaneously. The culture is one of extreme precision where being off by even a few microseconds can mean the difference between profit and loss. Jeff Yang spent formative years in this environment. He wasn't just learning how to trade, he was learning how to build systems that could operate at scales and speeds that most people can't even comprehend. He learned that in markets, speed matters but consistency matters more. He learned that the best systems are not the ones with the most features but the ones that never fail. He learned that when you're processing billions of dollars, there is no room for error, no tolerance for downtime, and no excuse for bugs. These lessons would become the foundation of everything he would later build. But Hudson River Trading taught him something else too. It taught him about the inefficiencies of traditional financial infrastructure. Even at a firm as sophisticated as Hudson River Trading, traders were still dependent on legacy systems, slow settlement times, and intermediaries that added costs and risks at every step. The infrastructure of traditional finance, no matter how much you optimized your own systems, was still fundamentally limited by decades-old architecture. This friction was everywhere. Settlement took days. Margin calculations were opaque. Liquidity was fragmented across dozens of venues. And all of this was controlled by centralized entities that could change the rules at any moment. Around 2017 and 2018, as Yang watched the cryptocurrency markets evolve, he began to see the potential for something radically different. Bitcoin had proven that you could have a decentralized form of money. Ethereum had shown that you could program financial logic into a blockchain. And projects like Uniswap were demonstrating that you could build functioning financial markets without traditional intermediaries. But something was missing. All of these decentralized systems were slow compared to traditional finance. They couldn't handle the trading volumes or speeds that real markets required. They had high fees that made certain types of trading impossible. And they lacked the sophisticated risk management and margin systems that professional traders needed. This gap between what crypto promised and what it could actually deliver became Yang's obsession. He started to ask a simple question: what would it take to build a decentralized exchange that could actually compete with centralized exchanges on performance while maintaining the trustless properties that made crypto valuable in the first place? This question would consume the next several years of his life. The challenge was immense. Decentralized systems are slow because they require consensus. Every transaction needs to be validated by multiple parties, and this takes time. Centralized exchanges are fast because one entity controls everything and can update account balances instantly in a database. But centralized exchanges require trust. Users have to believe that the exchange won't steal their money, won't front-run their trades, and won't manipulate the market. The history of crypto is filled with exchanges that violated this trust. Mt. Gox lost 450,000 Bitcoin. DeXs founder allegedly faked his death after losing access to $150 million in customer funds. FTX collapsed after its founder used customer deposits to fund his personal investments and luxury lifestyle. Every one of these collapses reinforced a fundamental truth: not your keys, not your coins. When you deposit money on a centralized exchange, you're trusting them completely. and history shows that trust is often misplaced. But decentralized exchanges had their own problems. Most DEXs in 2018 and 2019 were built on Ethereum, which meant they inherited all of Ethereum's limitations. Transaction fees were high and unpredictable. During periods of network congestion, a simple swap could cost $50 or more in gas fees. Settlement was slow, taking at least 12 to 15 seconds per block, and often much longer during busy periods. And the user experience was clunky, requiring multiple wallet confirmations and exposing users to complex concepts like slippage and front-running. For spot trading of tokens, these limitations were annoying but manageable. But for derivatives trading, perpetual futures, and leveraged positions, they were deal breakers. Professional traders need to be able to enter and exit positions instantly. They need to manage risk with precision. They need margin systems that can handle complex positions and liquidate them efficiently when necessary. And they need to do all of this with fees low enough that their strategies remain profitable. No existing decentralized exchange could offer this combination of features. Jeff Yang believed it was possible to solve these problems, but not by building on existing blockchain infrastructure. The solution would require building a new blockchain from the ground up, one designed specifically for high-performance trading. This blockchain would need to process thousands of transactions per second with latency measured in milliseconds, not seconds. It would need an order book model, not just an automated market maker, because order books are what professional traders are used to and what allows for more sophisticated trading strategies. It would need native margin and risk management systems built directly into the protocol. And it would need to do all of this while remaining decentralized and trustless. This vision became Hyperliquid. But turning vision into reality would require years of work and a team with exactly the right combination of skills. Yang began assembling that team, looking for people who understood both the technical challenges of building high-performance systems and the nuances of how real traders operate. The team he built was small but exceptionally talented. They came from backgrounds in quantitative trading, distributed systems, and cryptography. They shared Yang's obsession with building something that actually worked rather than something that just sounded good in a pitch deck. The first major decision was about the architecture. Most blockchain projects in this era were following one of two paths. Some were building on Ethereum as Layer 2 solutions, inheriting Ethereum's security but adding their own execution layer for better performance. Others were creating entirely new Layer 1 blockchains that could process transactions faster but had to build their own validator networks and security models. Each approach had trade-offs. Layer 2 solutions could leverage Ethereum's security and liquidity but were still ultimately limited by Ethereum's base layer capabilities. Layer 1 blockchains had more freedom to optimize performance but needed to solve the hard problem of decentralization and security from scratch. Hyperliquid chose to build a new Layer 1 blockchain. This was the harder path but the one that offered the most control over every aspect of the system. They could design the consensus mechanism specifically for low latency. They could optimize the state management for order book operations. They could build margin calculations directly into the protocol rather than as a smart contract layer on top. Every technical decision could be made with one goal in mind: create the fastest, most efficient decentralized trading platform possible. The architecture they designed was fundamentally different from most blockchains. Instead of trying to be a general-purpose platform that could run any application, Hyperliquid was built for one thing: trading. The blockchain itself understands orders, positions, margin, and liquidations as native concepts. This is similar to how Bitcoin's blockchain understands transactions and balances as native concepts. By building trading logic directly into the protocol, Hyperliquid could optimize performance in ways that wouldn't be possible if trading were just another smart contract application. The consensus mechanism was designed for speed. Traditional proof-of-work systems like Bitcoin are slow because they require miners to solve computational puzzles. Proof-of-stake systems like Ethereum are faster but still require multiple rounds of voting and confirmation to reach consensus. Hyperliquid uses a variant of Byzantine fault-tolerant consensus that can finalize blocks in under 1 second. The validator set is initially small and carefully selected, a design choice that sacrifices some decentralization in the short term for much better performance. The plan is to gradually increase the validator set over time as the technology matures. The order book implementation is another area where Hyperliquid's design differs from most DEXs. Most decentralized exchanges use automated market makers where liquidity providers deposit tokens into pools and an algorithm determines prices based on the ratio of tokens in the pool. This model works well for spot trading but has significant limitations for perpetual futures and leveraged trading. Order books, where buyers and sellers place limit orders at specific prices, are more complex to implement on a blockchain but offer much more precise price discovery and better execution for large trades. Hyperliquid's order book runs entirely on-chain. Every order is a transaction that gets included in a block and executed by validators. The matching engine that pairs buyers with sellers runs as part of the consensus process. This means that order execution is transparent and verifiable. Anyone can audit the order book to confirm that trades were executed fairly and that no front-running occurred. But it also means that the matching engine needs to be extremely efficient because it's running on every validator node simultaneously. The margin system is perhaps the most technically sophisticated part of Hyperliquid. Traditional exchanges calculate margin requirements based on your positions and account balance, then liquidate your positions if your margin falls below required levels. This sounds simple but becomes extremely complex when you're dealing with multiple positions across different assets, leverage ratios that can change, and market prices that are constantly moving. On a centralized exchange, margin calculations happen in a database that can be updated continuously. On a blockchain, these calculations need to happen in a way that's transparent, deterministic, and efficient enough to run on every validator. Hyperliquid solved this by building margin logic directly into the blockchain state machine. Your positions, your margin requirements, and your liquidation prices are all calculated by the protocol itself. When market prices move, the protocol automatically updates everyone's margin status. If someone falls below required margin levels, the liquidation process is triggered automatically by the blockchain, not by some centralized bot or keeper. This eliminates the possibility of selective liquidations or manipulation by the exchange operator because there is no exchange operator. The rules are in the code and they apply to everyone equally. The team spent much of 2020 and 2021 building and testing this infrastructure. This was during the height of the DeFi summer boom when new projects were launching every week, often with minimal testing and huge marketing budgets. Hyperliquid took the opposite approach. They built quietly, focusing on getting the technology right before seeking attention. There was no token launch, no public fundraising round, and no marketing campaign. This patient approach was unusual in crypto where the pressure to launch quickly and capitalize on market momentum is intense. But Yang and his team had learned from watching other projects fail. They had seen protocols launch with bugs that led to exploits and loss of user funds. They had seen systems that worked fine in testing but collapsed under real-world load. They had seen projects that generated hype but couldn't deliver on their promises. Hyperliquid would not make these mistakes. Every component would be tested exhaustively. The system would be proven to work at scale before opening to the public. And claims about performance would be backed by real data, not marketing spin. In 2022, as the broader crypto market entered a bear phase following the collapse of Terra Luna and the beginning of the FTX saga, Hyperliquid continued building. While other projects were cutting staff and shutting down, Hyperliquid stayed focused on their mission. This period, though difficult for the industry, provided valuable lessons. The collapse of centralized lenders like Celsius and Voyager, and especially the spectacular implosion of FTX in November 2022, reinforced why decentralized infrastructure mattered. FTX had seemed like one of the most trustworthy centralized exchanges. Its founder Sam Bankman-Fried was celebrated as a visionary and effective altruist. The exchange had major sponsorships, celebrity endorsements, and regulatory approval in multiple jurisdictions. And yet it turned out that FTX had been misusing customer funds on a massive scale, mixing exchange deposits with its trading firm Alameda Research, and using customer money to make risky investments and political donations. When FTX collapsed, billions of dollars of customer funds disappeared. Users who thought their money was safe in their exchange accounts discovered they were actually unsecured creditors in a bankruptcy proceeding. The ninth largest cryptocurrency exchange had turned out to be a fraud. This event sent shockwaves through the entire industry and led to a broader reckoning about centralization risk. If FTX could fail so catastrophically, what about other centralized exchanges? How could users ever really trust that their funds were safe? Hyperliquid's response to the FTX collapse was not to gloat or market aggressively, but to double down on their core mission. They published detailed technical documentation explaining how their system eliminated custodial risk. On Hyperliquid, users maintain control of their funds through their own private keys. The protocol itself cannot access user funds. Positions are tracked on-chain where anyone can verify them. Liquidations happen according to transparent rules that are enforced by code, not by human discretion. This wasn't just marketing talk, it was the fundamental architecture of the system. By early 2023, Hyperliquid was ready for a limited launch. The testnet had been running for months, processing millions of test trades and proving that the system could handle real trading activity. A small group of alpha users was invited to try the mainnet with real funds. This group included traders from various backgrounds, some from traditional finance, some from crypto-native trading firms, and some retail traders who were willing to experiment with new platforms. The feedback was overwhelmingly positive. Users were impressed by the speed. Orders executed in milliseconds, comparable to centralized exchanges and far faster than any other DEX. The order book was deep and liquid, with tight spreads on major trading pairs. And the user experience, while still technical, was significantly better than most decentralized alternatives. One of the most innovative aspects of Hyperliquid's launch was its approach to liquidity. Most new exchanges face a chicken and egg problem. Traders want to use platforms with good liquidity, but liquidity only comes from having many traders. Hyperliquid solved this through a combination of approaches. First, the team and early community members provided initial market making, ensuring that there were always orders in the book. Second, they designed incentive mechanisms that rewarded liquidity providers with a share of trading fees. And third, they focused on attracting sophisticated traders who could provide quality liquidity rather than just volume. The technical performance numbers were remarkable. Hyperliquid could process more than 20,000 orders per second. Block times were under 1 second. Trading fees were extremely low, often just a few dollars for trades worth millions. And because everything ran on-chain, users could verify that execution was fair and transparent. These weren't theoretical capabilities or testnet results, they were real numbers from the mainnet operating under actual trading conditions. But Hyperliquid wasn't just about technology. It was also about creating the right incentive structures and governance mechanisms. The team understood that a truly decentralized exchange needed to evolve beyond founder control. This meant building systems that could adapt to user needs, incorporate community feedback, and make decisions transparently. They designed a governance framework where major protocol changes would eventually be controlled by token holders, though this decentralization would happen gradually as the system matured. The approach to tokens and incentives was also unconventional. Many DeFi projects launch with aggressive token distribution programs that attract mercenary capital but don't create long-term users. Yield farmers come for the high returns, dump the tokens, and leave as soon as the rewards dry up. Hyperliquid took a more measured approach. Rather than paying users to trade, they focused on building genuine product-market fit. The goal was to attract users who valued the platform for its performance and features, not just for token rewards. This created more sustainable growth and a more committed user base. Throughout 2023, Hyperliquid's trading volume grew steadily. The platform began attracting attention from the broader crypto community. Traders shared their experiences on social media, often expressing surprise at how well the platform worked. The narrative began to shift from, can a decentralized exchange really compete with centralized platforms, to this actually works better than most centralized exchanges. Volume milestones came regularly. First $100 million in daily volume, then 500 million, then $1 billion. Each milestone validated the technology and proved that there was real demand for a high-performance decentralized alternative. The growth wasn't just about volume numbers. It was about the types of users and use cases the platform was enabling. Professional trading firms began using Hyperliquid for arbitrage strategies that required fast execution and low fees. Market makers provided liquidity across dozens of trading pairs. Retail traders used the platform for speculation and hedging. And institutional players started exploring Hyperliquid as a way to access crypto derivatives markets without the custodial risk of centralized exchanges. Each of these user groups had different needs and priorities, and Hyperliquid's flexible architecture could accommodate all of them. The competitive landscape was evolving too. In the early days of DeFi, most decentralized exchanges were focused on spot trading of tokens. Uniswap, SushiSwap, and PancakeSwap dominated this category with their automated market maker models. Derivatives trading remained primarily on centralized exchanges like Binance, FTX before its collapse, and Bybit. But by 2023, several projects were attempting to bring derivatives trading to decentralized platforms. DEX had launched its own blockchain for perpetual futures. GMX was gaining traction with its Oracle-based synthetic assets. And Synthetix was enabling various types of derivatives through its protocol. Each of these competitors had strengths and weaknesses. DEX had strong brand recognition and significant trading volume, but its tokenomics and regulatory approach created concerns. GMX offered innovative features like single-sided liquidity provision but relied on oracles in ways that introduced different trust assumptions. Synthetix enabled a wide variety of synthetic assets but had complex mechanics that made it difficult for average users to understand. Hyperliquid's advantage was its combination of performance, transparency, and user experience. The platform felt like using a centralized exchange but with the verifiable guarantees of decentralization. The question of decentralization itself deserves deeper examination because it's central to understanding what Hyperliquid represents. In the crypto world, decentralization is often treated as a binary concept. Either a system is decentralized or it's not. But in reality, decentralization exists on a spectrum and involves multiple dimensions. A system can be decentralized in its governance but centralized in its operation. It can be decentralized in its technical architecture but centralized in its token distribution. It can be decentralized in theory but centralized in practice if most users interact through a single interface or entity. Hyperliquid's approach to decentralization is pragmatic rather than ideological. The validator set is initially small, consisting of carefully selected node operators who can provide the infrastructure needed for high performance. This is less decentralized than Bitcoin or Ethereum but more decentralized than a centralized exchange where one company controls everything. The code is open source, meaning anyone can verify how the system works and propose changes. The protocol is designed so that users always control their own funds and can withdraw them at any time. And the roadmap includes plans to progressively decentralize governance and validator selection as the technology proves itself. This pragmatic approach reflects lessons from both traditional finance and crypto history. In traditional finance, Jeff Yang had seen how centralized control created risks and inefficiencies. But in crypto, he had also seen how premature or poorly executed decentralization could make systems unusable or insecure. The goal was to find the right balance, decentralized enough to eliminate custodial risk and censorship, but not so decentralized that performance suffered or governance became paralyzed. The engineering challenges of building Hyperliquid were immense and required solving problems that no one had solved before. Consider the problem of order matching at high speeds on a blockchain. On a centralized exchange, the matching engine is a piece of software running on powerful servers in a data center. When a new order comes in, the engine checks the order book, finds matching orders, executes the trades, and updates account balances. This all happens in microseconds because everything is in memory on fast hardware. On a blockchain, order matching needs to be deterministic and verifiable. Every validator needs to execute the matching algorithm and arrive at the exact same result. This means the algorithm needs to be part of the consensus protocol. But consensus protocols are designed to be robust and secure, not fast. They involve multiple rounds of communication between validators, cryptographic signatures, and careful state management. Making all of this fast enough for real-time trading required innovations at every layer of the stack. The Hyperliquid team optimized the consensus protocol to minimize communication rounds. They designed efficient data structures for the order book that could be updated quickly while maintaining consistency across validators. They implemented sophisticated caching strategies so that common operations could happen without touching disk storage. And they carefully profiled every component of the system to identify and eliminate bottlenecks. The result was a blockchain that could process trading operations at speeds that seemed impossible for decentralized systems. Another major challenge was the user experience. Cryptocurrency is notoriously difficult to use. Managing private keys, understanding gas fees, dealing with multiple wallet confirmations, and navigating complex DeFi protocols creates a barrier that keeps most people away. Hyperliquid needed to make trading as simple as possible while still maintaining the security properties that made decentralization valuable. This meant building intuitive interfaces, providing clear feedback about transaction status, and hiding unnecessary complexity from users who just wanted to trade. The team invested heavily in the user interface and user experience design. The trading interface looks and feels like a professional trading platform. There are charts, order books, position displays, and all the tools that traders expect. But under the hood, everything is happening on-chain. When you place an order, you're signing a transaction with your private key. When your order gets filled, that execution is recorded on the blockchain. And when you want to withdraw funds, you're using the blockchain's native withdrawal mechanism. The interface abstracts away the complexity while preserving the security. Education was another critical component. Even with a great interface, users needed to understand what made Hyperliquid different and why those differences mattered. The team created extensive documentation explaining how the system worked, from high-level concepts to technical details. They wrote blog posts comparing Hyperliquid to other approaches and explaining design decisions. They engaged with the community on social media and Discord, answering questions and gathering feedback. And they were transparent about limitations and areas where the system was still evolving. This transparency extended to how the team communicated about risks. Every trading platform involves risks, and decentralized platforms introduce some risks that centralized platforms don't have. Smart contract bugs could potentially lead to loss of funds. Blockchain reorganizations could affect transaction finality. Novel attack vectors might emerge as the system scaled. The Hyperliquid team was upfront about these risks rather than downplaying them. They encouraged users to start with small amounts, to understand the technology before committing significant capital, and to think carefully about their risk tolerance. The security approach was multi-layered. The core protocol went through extensive internal testing and multiple external audits. But the team knew that audits alone weren't sufficient. The system needed to be battle-tested with real value at stake. This is why the launch was gradual, starting with a small user base and limited total value locked, then slowly expanding as confidence in the system grew. At each stage, the team monitored the system carefully, looking for anomalies, gathering performance data, and making incremental improvements. One of the most interesting aspects of Hyperliquid's development was how the team thought about failure modes. In any complex system, things can go wrong. Hardware can fail, networks can partition, bugs can manifest, and adversaries can attack. The question is not whether failures will occur but how the system responds when they do. Hyperliquid was designed with graceful degradation in mind. If a validator goes offline, the system continues operating with the remaining validators. If network latency increases, block times might slow slightly but trades still execute. If an unusual market condition is detected, safety mechanisms can pause certain operations until the situation is resolved. These failure mode considerations reflected Jeff Yang's background in high-frequency trading. At Hudson River Trading, systems needed to handle not just normal market conditions but also flash crashes, data feed failures, exchange outages, and all sorts of unexpected scenarios. The best systems were those that could operate reliably across all conditions, not just the happy path. This same philosophy guided Hyperliquid's architecture. Every component was designed to be robust, with fallbacks and safety mechanisms for when things didn't go as planned. As Hyperliquid gained traction in 2023, the team faced new challenges around scaling and ecosystem development. Trading volume was growing rapidly, which was good, but it also meant the system needed to handle more load. The validator infrastructure needed to scale horizontally to process more transactions. The order book needed to maintain performance even with thousands of active orders. And the user interface needed to remain responsive even as more traders were using it simultaneously. The approach to scaling was methodical. Rather than trying to handle unlimited volume from day one, the team scaled capacity in steps, carefully measuring performance at each level. They added validators gradually, ensuring that consensus remained fast even with more nodes participating. They optimized database queries and caching strategies to reduce latency. And they implemented rate limiting and other protective measures to prevent any single user or bot from overwhelming the system. This measured approach avoided the problems that had plagued other platforms when they scaled too quickly without sufficient infrastructure. Ecosystem development was equally important. A trading platform is only as valuable as its ecosystem of traders, market makers, liquidity providers, and tool builders. Hyperliquid needed to foster a thriving ecosystem without controlling it centrally. This meant providing APIs and documentation that developers could use to build tools and integrations. It meant creating incentive programs that attracted quality market makers. It meant engaging with the community to understand their needs and priorities. And it meant being open to partnerships and integrations with other protocols and platforms. The community that formed around Hyperliquid was distinct from many other crypto communities. Rather than being primarily focused on token price speculation, the Hyperliquid community was interested in trading and technology. Users shared strategies, discussed market conditions, and provided feedback on features. Developers built trading bots, analytics tools, and alternative interfaces. Market makers competed to provide the best liquidity. This created a virtuous cycle where the platform improved because of community involvement, which attracted more sophisticated users, which led to more innovation. The question of token economics and value accrual was something the team thought about carefully. Many DeFi protocols have tokens that are primarily used for governance, with unclear value capture mechanisms. Users are asked to hold tokens to vote on protocol changes, but there's often no direct financial benefit to doing so. This creates a disconnect where the protocol can be successful but the token still struggles to maintain value. Hyperliquid's approach was to design tokenomics where value flows to token holders in clear and sustainable ways. Trading fees are one source of value. On Hyperliquid, a portion of trading fees is used to buy back and burn tokens, reducing supply over time. Another portion goes to liquidity providers and stakers who are providing value to the network. And another portion funds ongoing development and ecosystem growth. This creates multiple sources of value accrual and ensures that as the platform grows, token holders benefit directly. But importantly, the token is not required to use the platform. You can trade on Hyperliquid without ever buying or holding the token, which keeps the user experience simple and avoids regulatory complexities. The regulatory environment for cryptocurrency evolved significantly during Hyperliquid's development. In the United States, the SEC became increasingly aggressive in pursuing DeFi protocols, arguing that many tokens were unregistered securities and that DeFi platforms were operating as unregistered exchanges. Several prominent projects received Wells notices or were sued by the SEC. This created uncertainty for the entire industry and forced projects to think carefully about how they structured their tokens, governance, and operations. Hyperliquid's approach was to focus on building technology and protocol infrastructure rather than on token promotion or marketing. The team believed that by avoiding aggressive token launches, yield farming schemes, and other practices that might attract regulatory attention, they could stay focused on their core mission. They also believed that true decentralization was the best regulatory defense. If the protocol operates autonomously according to code, with no central party controlling it or profiting from it, then traditional regulatory frameworks don't apply as clearly. This wasn't about trying to evade regulation. It was about building systems that fit into a different category entirely. Just as Bitcoin is not considered a security because it's sufficiently decentralized and has no identifiable issuer, truly decentralized protocols might not fit into existing regulatory boxes. But achieving true decentralization requires more than just technical architecture. It requires decentralized governance, broad token distribution, and no single point of control. These were long-term goals for Hyperliquid, not day-one realities. By mid-2023, Hyperliquid had proven that its technology worked and that there was real demand for high-performance decentralized derivatives trading. Daily trading volume regularly exceeded $1 billion. The platform had processed hundreds of millions of trades without any significant security incidents or downtime. Users were providing positive feedback about performance and features. And competitors were taking notice, with several other projects attempting to replicate Hyperliquid's approach or claiming to offer similar capabilities. The next phase was about expanding beyond just perpetual futures trading. The core infrastructure that Hyperliquid had built, a high-performance blockchain optimized for financial operations, could support many other use cases. Spot trading of tokens was an obvious addition. Options and other derivatives could leverage the same margin system and order book infrastructure. Lending and borrowing markets could be built on top of the platform. Even more complex financial products like structured notes or portfolio margin could be implemented. But expansion had to be done carefully. Each new feature added complexity to the protocol and potential new attack surfaces. The team's philosophy was to add features only when they could be implemented with the same level of performance and security as existing features. This meant saying no to many requested features, at least in the short term, and focusing on doing a few things extremely well rather than many things poorly. The market conditions of late 2023 and early 2024 were favorable for Hyperliquid's growth. The crypto market was recovering from the bear market that had followed the collapse of Terra Luna and FTX. Bitcoin was rallying toward new all-time highs, driven by anticipation of spot Bitcoin ETF approvals and broader institutional adoption. Trading volume across the industry was increasing. And there was renewed optimism about crypto's long-term potential. Hyperliquid benefited from this broader market recovery, but also from specific factors that drove traders to the platform. The memories of FTX's collapse were still fresh, making custodial risk a top concern for anyone trading derivatives. Centralized exchanges were facing increased regulatory scrutiny and uncertainty. And the performance gap between centralized and decentralized platforms was narrowing as Hyperliquid and other high-performance protocols matured. For many traders, the choice was becoming clear: why take custodial risk on a centralized exchange when you can get similar performance without that risk on Hyperliquid? The competitive dynamics in decentralized derivatives were intensifying. DEX remained the market leader by volume but was transitioning to its own blockchain and facing questions about its token economics and centralization. GMX was popular but served a somewhat different user base focused on longer-term positions rather than active trading. Perpetual Protocol, Quenta, and several others were competing for market share. Each platform had its strengths and its advocates. The market was large enough to support multiple winners, but competition was pushing every platform to improve. Hyperliquid's competitive advantages were becoming clearer. Performance was the most obvious, with execution speeds and throughput that rivaled centralized exchanges. The user experience was another differentiator, with an interface that felt professional and responsive rather than clunky and slow. The order book model appealed to traders who wanted precise price discovery and the ability to place sophisticated order types. And the security model, with users maintaining custody of their funds, eliminated the existential risk that centralized platforms carried. But Hyperliquid also faced challenges and criticisms. Some argued that the validator set was too small and centralized, giving the team too much control over the network. Others pointed out that the token had not been widely distributed, creating concerns about fairness and decentralization. There were questions about how the platform would perform under extreme market stress, during flash crashes or periods of very high volatility. And some users wanted features that Hyperliquid didn't yet offer, like mobile apps, fiat on-ramps, or integration with popular wallets. The team's response to criticism was generally measured and thoughtful. They acknowledged areas where Hyperliquid was not yet fully decentralized and laid out plans for progressive decentralization over time. They explained the engineering trade-offs that led to certain design decisions. They were transparent about limitations and areas for improvement. And they prioritized building and shipping actual improvements over engaging in marketing battles with competitors. This approach might not have generated as much hype as some alternatives, but it built credibility and trust with serious users. Jeff Yang himself remained relatively low profile throughout this period. Unlike many crypto founders who become celebrities and spend significant time on social media and at conferences, Yang stayed focused on building. He gave occasional interviews and participated in some community discussions, but his primary focus was always on the technology and the product. This was consistent with the culture at Hudson River Trading, where the focus was on performance and results rather than publicity and self-promotion. The influence of Hudson River Trading on Hyperliquid's culture and approach was profound and worth examining in more detail. Hudson River Trading was founded on several core principles. First, hire the best people you can find and give them the freedom to solve hard problems. Second, focus on what actually works rather than what sounds good in theory. Third, be rigorous about testing and measurement. Fourth, maintain high ethical standards even when no one is watching. And fifth, optimize for long-term success rather than short-term wins. Each of these principles was evident in how Hyperliquid operated. The team was small but exceptionally talented, with deep expertise in their respective areas. The technology was built to work in practice, not just to impress in demos or white papers. Every component was extensively tested with real data and real loads. The team's ethical standards were high, with transparency about risks and honest communication about limitations. And the long-term focus was evident in decisions to build slowly and carefully rather than rushing to capture market hype. This cultural DNA made Hyperliquid different from many crypto projects. The crypto industry has historically attracted a mix of brilliant innovators, opportunistic grifters, and everything in between. Many projects are launched with sophisticated marketing and ambitious promises but limited technical substance. Teams raise money through token sales, spend heavily on marketing and exchange listings, and often deliver far less than they promised. The incentives in crypto often favor short-term thinking and hype over sustainable value creation. Hyperliquid represented a different model. The focus was on building real technology that solved real problems. Marketing was minimal and organic, driven by users sharing their experiences rather than paid promotions. Fundraising was private and from strategic partners rather than through public token sales. And timelines were set by when features were ready rather than by market conditions or hype cycles. This approach was slower and less flashy, but it built a foundation for long-term success. The technical innovations that Hyperliquid pioneered are worth understanding in detail because they represent genuine advances in blockchain technology. Consider the problem of maintaining an order book on a blockchain. Traditional blockchains like Bitcoin and Ethereum store relatively simple state, account balances, and smart contract storage. When a transaction occurs, the state is updated in straightforward ways. Add some amount to one account, subtract it from another, update a few smart contract variables. An order book is far more complex. You need to store all active orders with their prices, quantities, and timestamps. When a new order comes in, you need to match it against existing orders, execute trades if there are matches, update account balances, adjust positions, calculate margin requirements, and potentially trigger liquidations if margin falls too low. All of this needs to happen atomically and consistently across all validators. And it needs to happen fast enough that users don't experience noticeable delays. The state management system that Hyperliquid designed uses advanced data structures that allow for efficient queries and updates. Orders are indexed in multiple ways so that finding matching orders is fast. Position calculations use incremental updates rather than recalculating everything from scratch. Margin requirements are computed using formulas that can be evaluated quickly but still capture the relevant risks. The entire system is optimized for the specific operations that trading requires, rather than being a general-purpose computation platform. The consensus protocol is another area of innovation. Most blockchain consensus protocols are designed to be Byzantine fault-tolerant, meaning they can tolerate some validators being malicious or faulty without compromising the system's integrity. But achieving BFT typically requires multiple rounds of communication between validators, which adds latency. Hyperliquid's consensus protocol is optimized for the common case where validators are honest and the network is well connected. Under these conditions, consensus can be reached very quickly. But the protocol still handles Byzantine faults correctly when they occur, ensuring safety even under attack. The networking layer is optimized for low-latency communication between validators. This might seem like a minor detail, but in a system where every millisecond matters, network optimization is crucial. The team carefully selected validator locations to minimize round-trip times. They implemented efficient serialization protocols to reduce the amount of data that needs to be transmitted. They used UDP instead of TCP for certain operations where the lower latency of UDP outweighs its reliability disadvantages. All of these optimizations add up to a system that can operate at speeds that seem impossible for decentralized systems. As 2024 progressed, Hyperliquid continued to grow and evolve. New features were added based on user feedback and market needs. The platform expanded to support more trading pairs, giving users more options for where to deploy their capital. Improvements to the matching engine and risk systems allowed for more sophisticated trading strategies. And the user interface was refined based on feedback from thousands of traders who were using the platform daily. The community around Hyperliquid was maturing as well. Early adopters who had taken a chance on the platform when it was new and unproven were now vocal advocates. Trading firms that had initially tested Hyperliquid with small amounts were now routing significant volume through the platform. And developers were building tools and integrations that made Hyperliquid more accessible and useful. This ecosystem growth was organic and sustainable, driven by genuine product-market fit rather than artificial incentives. One of the most significant developments in this period was the growth of liquidity. Liquidity, the ability to trade large amounts without significantly moving the price, is crucial for any trading platform. In the early days, Hyperliquid's liquidity was thin, meaning that large trades could have substantial price impact. But as more market makers joined the platform and more traders provided liquidity, the order book became deeper and spreads became tighter. This made the platform more attractive for larger traders and institutional players, which in turn attracted even more liquidity in a virtuous cycle. The economics of market making on Hyperliquid were favorable. Because trading fees were low and execution was fast, market makers could profit from providing liquidity even with relatively tight spreads. The on-chain nature of the order book meant that market makers could verify that their orders were being executed fairly without front-running or other manipulation. And the margin system allowed market makers to use their capital efficiently, maintaining positions across multiple markets without needing to over-collateralize. Professional market-making firms began to take notice. These firms, which provide liquidity on traditional exchanges and other crypto platforms, started allocating resources to Hyperliquid. Some deployed their existing algorithms with minor modifications. Others developed new strategies specifically optimized for Hyperliquid's unique characteristics. The presence of professional market makers improved the platform's liquidity and made it more competitive with centralized exchanges. The institutional interest extended beyond just market making. Proprietary trading firms that traded on centralized exchanges were exploring Hyperliquid as an alternative. Family offices and asset managers that wanted exposure to crypto derivatives but were uncomfortable with custodial risk found Hyperliquid appealing. And even some traditional finance entities that had been skeptical of crypto were paying attention because Hyperliquid demonstrated that decentralized systems could achieve performance comparable to centralized ones. This institutional interest raised new questions about Hyperliquid's future direction. Should the platform optimize for institutional users with features like dedicated API endpoints, premium support, and institutional-grade reporting? Or should it remain focused on being open and permissionless, treating all users equally regardless of their size? The team's philosophy was to maintain permissionless access while building features that anyone could use. If institutions found those features valuable, that was great, but the platform wouldn't create special access or privileges for large users. The regulatory conversations became more sophisticated as well. Early discussions about crypto regulation often treated all tokens as securities and all platforms as exchanges, applying traditional financial regulations without much nuance. But by 2024, regulators were beginning to understand the differences between centralized and decentralized systems. Some jurisdictions were creating specific frameworks for DeFi that recognized its unique characteristics. Others were taking enforcement actions but providing more clarity about what was and wasn't acceptable. Hyperliquid's position in this evolving regulatory landscape was complex. On one hand, the platform was clearly facilitating derivatives trading, an activity that is heavily regulated in most jurisdictions. On the other hand, Hyperliquid was decentralized in ways that made traditional regulation difficult to apply. There was no central exchange operator to regulate. Users maintained custody of their funds. The protocol executed trades according to code without human intervention. These characteristics might place Hyperliquid in a different category than centralized exchanges, but the regulatory treatment was still uncertain. The team's approach was to engage constructively with regulators while staying true to their decentralization principles. They participated in industry discussions about appropriate regulation for DeFi. They were transparent about how the protocol worked and who controlled what. And they avoided practices that would clearly run afoul of existing regulations, like offering services to US users in ways that might violate securities laws or derivatives regulations. This careful approach didn't eliminate regulatory risk, but it minimized it while preserving the platform's core values. The broader narrative around DeFi was shifting in ways that benefited Hyperliquid. After the collapses of Terra, FTX, and numerous DeFi protocols in 2022, there had been widespread skepticism about whether decentralized finance could work at all. Many observers concluded that DeFi was fundamentally flawed, too complex, too risky, and too prone to exploits and failures. But by 2024, a more nuanced view was emerging. Yes, many DeFi projects had failed, but some were succeeding and demonstrating real value. The key was distinguishing between well-designed protocols with genuine decentralization and poorly designed systems that were decentralized in name only. Hyperliquid was increasingly seen as an example of DeFi done right. The technology worked. The security model was sound. The performance was competitive with centralized alternatives. And the team was building deliberately and responsibly rather than hyping and dumping. This reputation attracted users who had been burned by other DeFi platforms and were looking for something more reliable. It also attracted developers and researchers who wanted to understand how Hyperliquid achieved its performance and whether its approach could be applied to other problems. The academic interest in Hyperliquid was growing as well. Researchers studying blockchain scalability, DeFi protocol design, and market microstructure were analyzing Hyperliquid as a case study. Papers were published examining Hyperliquid's consensus mechanism, order book implementation, and market quality. Some of this research validated Hyperliquid's design choices, while other work identified potential improvements or limitations. The team welcomed this scrutiny because it helped identify issues and drove the technology forward. Jeff Yang's vision for Hyperliquid extended beyond just being a successful trading platform. He saw Hyperliquid as proving that decentralized systems could compete with centralized ones on performance without sacrificing security or trust. If Hyperliquid succeeded, it would demonstrate that the trade-offs between decentralization and performance that many people assumed were fundamental could actually be overcome with the right technology and design. This had implications far beyond just crypto trading, potentially influencing how financial systems, supply chains, and other critical infrastructure could be built in the future. The philosophical underpinnings of Hyperliquid reflected Yang's experiences in both traditional finance and crypto. From traditional finance, he understood the importance of performance, reliability, and user experience. Systems needed to work correctly under all conditions, not just the easy ones. From crypto, he understood the value of decentralization, transparency, and removing trusted intermediaries. These values weren't just ideological preferences, they addressed real problems that centralized systems couldn't solve. The synthesis of these two worldviews was what made Hyperliquid distinctive. It wasn't trying to be pure and ideologically perfect in its decentralization at the expense of being usable. But it also wasn't abandoning decentralization for the sake of performance. Instead, it found ways to achieve both goals simultaneously through careful engineering and thoughtful design. This pragmatic approach might not satisfy purists on either side, but it created something that actually worked and that people wanted to use. As Hyperliquid's trading volume and user base continued to grow through 2024, the platform faced scaling challenges that tested its architecture and the team's engineering capabilities. When daily trading volume approached $5 billion and the platform was processing tens of thousands of trades per day, the infrastructure needed to handle much more load than it had been designed for initially. This is a good problem to have, but it's still a problem that requires solutions. The team approached scaling systematically. They profiled the entire system to identify bottlenecks. They optimized database queries that were becoming slow under load. They added more validator capacity and improved the consensus protocol's efficiency. They implemented better caching strategies to reduce redundant computations. And they made architectural changes that would support even higher volumes in the future. All of this work happened while the platform was running, requiring careful coordination to avoid disruptions to users. One of the most impressive aspects of Hyperliquid scaling was that it happened without compromising security or decentralization. Many platforms, when they scale, end up making trade-offs that centralize control or reduce security guarantees. Hyperliquid maintained its core properties even as it grew. Users still controlled their funds. Trades still executed on-chain transparently. And the validator set, while still relatively small, was gradually expanding and becoming more geographically distributed. The user experience improvements during this period were significant. The interface became more responsive and feature-rich. Advanced order types were added, giving traders more control over their executions. Mobile optimization made the platform usable on phones and tablets, not just desktop computers. Integration with popular wallets made it easier for new users to get started. And educational resources helped users understand how to use the platform effectively and safely. These improvements were driven by user feedback but also by the team's own vision for what a great trading platform should look like. Jeff Yang and his colleagues had used the best trading platforms in both traditional finance and crypto, and they knew what good looked like. They set high standards for themselves and were never satisfied with just being good enough. Every detail mattered, from the responsiveness of the interface to the clarity of error messages to the accuracy of position displays. The competition was intensifying but also validating Hyperliquid's approach. Other projects were attempting to build high-performance decentralized exchanges, often explicitly citing Hyperliquid as a benchmark. Some were building on their own blockchains like Hyperliquid had. Others were exploring Layer 2 solutions or optimistic roll-ups. And a few were trying entirely different approaches like trusted execution environments or zero-knowledge proofs. The diversity of approaches being tried was healthy for the ecosystem and pushed everyone to innovate. The Hyperliquid community's culture was evolving into something distinct. Unlike many crypto communities that focus heavily on price speculation and when-mooned discussions, the Hyperliquid community was more focused on trading strategies, technical discussions, and product feedback. The Discord and social media channels had active conversations about market conditions, platform features, and optimal strategies. This created a more mature and sustainable community compared to many hype-driven projects. The market makers and liquidity providers on Hyperliquid formed their own sub-community. These sophisticated users shared insights about optimal market-making strategies, discussed how to handle large orders, and coordinated to improve overall market quality. Some competition existed between market makers for the best positions and most profitable trading pairs, but there was also collaboration and mutual support. This community of professional liquidity providers was crucial to Hyperliquid's success and helped distinguish it from platforms with thin, unreliable liquidity. As we move toward the present day, Hyperliquid stands as one of the most successful examples of high-performance decentralized infrastructure in the crypto industry. The platform processes billions of dollars in trading volume daily, has thousands of active users, and has proven that decentralized systems can compete with centralized ones on performance. But more important than the numbers is what Hyperliquid represents, a vision of how financial infrastructure can be built to be both performant and trustless, both user-friendly and genuinely decentralized. Jeff Yang's journey from quantitative trading at Hudson River trading to building one of crypto's most advanced protocols demonstrates several important lessons. First, deep expertise in traditional finance combined with understanding of blockchain technology creates powerful opportunities for innovation. Second, building slowly and carefully with focus on fundamentals creates more sustainable success than rushing to capture hype. Third, performance and user experience matter enormously even in decentralized systems. And fourth, maintaining high ethical standards and transparency builds trust that cannot be bought with marketing. The story of Hyperliquid is still being written. The platform continues to evolve with new features and improvements being developed. The regulatory landscape continues to shift in ways that will affect how Hyperliquid and similar platforms operate. Competition will intensify as more projects attempt to solve similar problems. And the broader crypto market will go through more cycles of boom and bust that will test every platform's resilience. But regardless of what happens next, Hyperliquid has already demonstrated something important. It has shown that the vision of decentralized finance, where users can trade and access financial services without trusted intermediaries, is not just a theoretical possibility but a practical reality. The trade-offs between decentralization and performance that many people assumed were fundamental can be overcome with the right technology and approach. And when built correctly, decentralized systems can attract real users, process real volume, and create real value. The broader implications of what Hyperliquid has achieved extend far beyond crypto trading. If decentralized systems can match or exceed centralized ones in performance while offering better security and trust properties, then many other applications become possible. Decentralized lending, decentralized options markets, decentralized asset management, and even entirely new financial products that were previously impossible could all be built using similar approaches. Hyperliquid's technology and design principles could influence how financial infrastructure is built for decades to come. For Jeff Yang personally, Hyperliquid represents the culmination of years of experience and learning. His time at Hudson River trading taught him how to build high-performance systems and think rigorously about markets. His observation of crypto's evolution showed him what was possible with decentralized systems and where the gaps were. And his work building Hyperliquid demonstrated that these two worlds, high-performance trading and genuine decentralization, could be brought together successfully. This is a rare achievement that few people could have accomplished. The team that Yang assembled deserves enormous credit as well. Building something as complex and ambitious as Hyperliquid required not just one brilliant person but a group of exceptional individuals working together toward a common vision. The engineers who optimized every line of code for performance, the designers who made the interface intuitive, the community managers who built relationships with users, and everyone else who contributed to Hyperliquid's success played essential roles. Great projects are always team efforts, even when one person gets most of the attention. Looking forward, the questions about Hyperliquid's future are fascinating to consider. Will it continue to grow and eventually become one of the dominant trading venues in crypto? Will it expand beyond derivatives trading into other financial services? Will it achieve true decentralization with a large, diverse validator set and community governance? Will it face regulatory challenges that force changes to its structure or operations? Will competitors develop better technology that makes Hyperliquid obsolete? These questions don't have certain answers, but exploring them helps us understand both Hyperliquid's potential and its risks. The path to increased decentralization is particularly interesting. As discussed earlier, Hyperliquid started with a relatively small, curated validator set to ensure high performance. But the long-term vision is for progressive decentralization where more validators can join, governance becomes more distributed, and no single entity has control over the protocol. This transition is technically challenging because it needs to happen without sacrificing performance or security. It's also socially and politically challenging because it requires the founding team to gradually give up control. Many blockchain projects have struggled with this transition. Some never seriously attempt it, remaining centralized despite claims of decentralization. Others decentralize too quickly before the technology is ready, leading to governance problems or security issues. The successful path requires careful planning, incremental steps, and alignment between the technical architecture and the governance structure. Hyperliquid's team has been thoughtful about this challenge, but executing the transition successfully over the coming years will be one of their biggest tests. The token economics and value capture mechanisms will also evolve. As the platform matures and generates more revenue from trading fees, how that value flows to different stakeholders becomes increasingly important. Token holders want to benefit from the platform's success. Liquidity providers need to be incentivized appropriately. And the protocol needs funding for ongoing development and improvements. Balancing these different interests requires careful design and willingness to adapt as circumstances change. The competitive dynamics will continue to evolve in unpredictable ways. Today's competitors might fail or succeed in unexpected ways. New competitors with different approaches might emerge. Or the competitive landscape might shift entirely as the broader crypto market changes. The key for Hyperliquid will be to stay focused on its core mission of providing the best possible trading experience while maintaining genuine decentralization. If it does that consistently, it can weather whatever competitive challenges arise. The regulatory environment remains perhaps the biggest uncertainty. Different jurisdictions are taking vastly different approaches to crypto regulation. Some, like Singapore and Switzerland, are creating clear frameworks that try to balance innovation with investor protection. Others, like the United States, are taking more aggressive enforcement approaches without always providing clear guidance. And some jurisdictions are effectively banning crypto activities altogether. How Hyperliquid navigates this fragmented regulatory landscape while maintaining its decentralized principles will be crucial to its long-term success. The technological evolution of blockchain and DeFi will also affect Hyperliquid's trajectory. New approaches to consensus, scaling, and privacy are being developed constantly. Zero-knowledge proofs might enable new functionality or better privacy. Layer 2 technologies might offer different trade-offs between performance and decentralization. Interoperability between blockchains might become more seamless, changing how users interact with different protocols. Hyperliquid will need to evaluate these developments and incorporate beneficial innovations while staying true to its core architecture and principles. The story of Jeff Yang and Hyperliquid offers several broader lessons about innovation, entrepreneurship, and technology development. First, deep domain expertise matters. Yang's experience in high-frequency trading gave him insights that someone without that background would lack. Second, patience and focus on fundamentals create more sustainable success than chasing short-term hype. Third, the best products often come from teams that are building for themselves, solving problems they personally understand and care about. And fourth, transparency and integrity build trust that no amount of marketing can replicate. For the crypto industry as a whole, Hyperliquid demonstrates what's possible when talented teams focus on solving real problems rather than just creating hype. The industry has been plagued by scams, failures, and broken promises. But projects like Hyperliquid show that the underlying technology has genuine potential and can create real value when built correctly. This is important for the industry's credibility and long-term success. For users and traders, Hyperliquid offers a glimpse of what the future of finance might look like. A world where you can access sophisticated financial services without needing to trust centralized intermediaries. Where your funds are always under your control. Where markets are transparent and fair because everything happens on-chain. Where performance is comparable to traditional systems but with better security properties. This vision is appealing, but realizing it fully will require continued technological development and broader adoption. The human story behind Hyperliquid is ultimately one of vision, execution, and perseverance. Jeff Yang saw a problem that needed solving, developed a clear vision for how to solve it, assembled a talented team, and executed relentlessly over several years. There were no shortcuts, no quick wins, just steady progress toward a clear goal. This approach is less common in crypto, where many projects promise revolutionary outcomes from day one, but it's the approach that creates lasting value. As we conclude this exploration of Jeff Yang and Hyperliquid, several key themes emerge. First, the importance of combining traditional finance expertise with blockchain technology understanding. Second, the value of building slowly and carefully with focus on fundamentals rather than hype. Third, the possibility of achieving both high performance and genuine decentralization when the right technical choices are made. Fourth, the crucial role of community and ecosystem in a platform's success. And fifth, the ongoing challenges of scaling, governance, and regulatory compliance that all successful crypto projects must navigate. Hyperliquid's story is far from over. The platform will continue evolving, facing new challenges, and pursuing its vision of high-performance decentralized trading. Jeff Yang and his team will make countless more decisions that shape the platform's trajectory. The crypto industry will go through more cycles and transformations. And users will continue to vote with their capital, choosing platforms that best serve their needs. But regardless of what happens next, Hyperliquid has already secured its place as one of the most significant innovations in decentralized finance. The lessons from this journey extend beyond just crypto or finance. They speak to broader questions about how we build systems that serve human needs, how we balance competing values like performance and decentralization, and how we create technology that empowers rather than controls. These are questions that will remain relevant as technology continues reshaping society in profound ways. And the answers that projects like Hyperliquid provide will influence not just the future of finance but the future of how we organize and coordinate human activity more broadly. For anyone interested in entrepreneurship, technology, or finance, the Hyperliquid story offers valuable insights and inspiration. It shows that ambitious visions can be realized through focused execution and technical excellence. It demonstrates that building for the long term creates more value than optimizing for short-term gains. And it proves that maintaining high ethical standards and transparency doesn't have to come at the expense of success. These lessons are worth remembering as we navigate an increasingly complex and rapidly changing technological landscape. The impact of Hyperliquid on the individuals who built it and use it is also worth considering. For Jeff Yang and the core team, building Hyperliquid has been an all-consuming mission that has shaped their professional lives and personal identities. For the traders and market makers who use the platform, it provides tools and opportunities that simply didn't exist before. For the broader crypto community, it demonstrates what's possible and raises the bar for what people should expect from DeFi platforms. And for the world beyond crypto, it offers a proof point that decentralized systems can work at scale and compete with traditional alternatives. As we look to the future, the questions are endless and fascinating. Will Hyperliquid reach its goal of being the premier decentralized trading platform? Will it expand into new products and services? Will it maintain its technical edge as competitors improve? Will it successfully decentralize governance and control? Will it navigate regulatory challenges effectively? Will it continue to innovate and push the boundaries of what's possible? These questions will be answered over time through the actions and decisions of Jeff Yang, his team, the Hyperliquid community, and the market as a whole. What we can say with certainty is that Hyperliquid has already made significant contributions to the crypto industry and to our understanding of what decentralized systems can achieve. It has pushed the boundaries of blockchain performance. It has demonstrated that user experience and decentralization can coexist. It has built a sustainable business model that doesn't rely on unsustainable token incentives. And it has created value for thousands of users who can now trade derivatives without custodial risk. These achievements are real and meaningful regardless of what happens next. The story of Jeff Yang and Hyperliquid is ultimately a story about the power of focused execution in service of a clear vision. In a world of noise, hype, and short-term thinking, they chose to build slowly and carefully. In an industry prone to cutting corners and making compromises, they maintained high standards. And in an environment where many projects fail to deliver on their promises, they built something that actually works. This is the kind of story that deserves to be told and remembered as the crypto industry matures and evolves. As this documentary concludes, the invitation is for listeners to reflect on the lessons and implications of what has been shared. Whether you're a trader considering using Hyperliquid, an entrepreneur thinking about what to build next, or simply someone interested in how technology is reshaping finance, there is something here worth considering. The journey from quantitative trading at Hudson River trading to building one of crypto's most advanced protocols is a remarkable one with lessons that extend far beyond just one platform or one person. The future of finance is being built today by people like Jeff Yang and teams like the one behind Hyperliquid. These builders are working to create systems that are more transparent, more efficient, and more accessible than what exists today. The path is not easy and success is never guaranteed. But the potential impact of getting this right is enormous. If decentralized systems can truly compete with and eventually surpass centralized ones, it will transform not just how we trade and invest but how we think about trust, intermediation, and the organization of economic activity. Thank you for joining this exploration of Jeff Yang and Hyperliquid. The story continues to unfold day by day as the platform grows, evolves, and faces new challenges and opportunities. For those interested in following along, the Hyperliquid platform itself offers the most direct way to see the technology in action. The community discussions provide insights into how users are experiencing and thinking about the platform. And the ongoing development updates show how the team continues to innovate and improve. The journey is far from over, and the most interesting chapters may still be ahead.